Hello, my name is Aaron Dubnikoff, and I'm Managing Director of Sales for Arrow Capital Management, and I cover advisor teams in Manitoba and Saskatchewan. Thank you very much for attending our first webinar of 2023, featuring Portfolio Manager Ted Whitehead, who will be providing us with an update on the Exemplar Growth and Income Fund and his thoughts on positioning for 2023. Joining myself and Ted to assist with the Zoom technology is our colleague from Toronto, Madeline Barkey. Also in attendance are many more of our Arrow Capital teammates and, of course, advisors and associates from coast to coast in Canada. 2022 was an exciting year for Arrow Capital. We moved into new offices at 100 Yonge Street in Toronto. We made 2 additions to our sales team, hiring very well-respected industry veterans, Tim Shrigley in British Columbia, and also John Tedesco in Ontario. We also celebrated the 1-year anniversary of the Exemplar Global Growth and Income Fund, and our investment solutions performed very well through extremely challenging markets. So I just described 2022's markets as very challenging. What word or words would you use to describe the markets that we experienced in 2022? Would it have been volatile, terrible, frustrating, opportunistic, or maybe you thought of a word or words that we can't really say out loud on a family broadcast? One thing I think we could agree on is that 2022 was probably the worst year that any of us have ever experienced for the static 60-40 equity income portfolio. So it maybe reinforces the need to consider more actively managed solutions, or including properly managed liquid alternative strategies to portfolios as a means to reduce volatility and improve performance. I had a chance just this week to speak with a branch manager at one of the large Canadian bank-owned firms, and he reminded me how challenging it can be for advisors to find new clients. And after all of that effort spent on bringing on a new client, the last thing that you want to have happen is to lose a client because their portfolio experienced too much volatility. So I hope that our presentation today will either introduce you to or remind you of how well-positioned Arrow Capital Management is to help you and your clients navigate through what is likely to be another challenging year. Please note that we will have some time at the end of Ted's presentation for Q&A, and I will remind you that you can click on the question box and enter your question. And we will get to as many of the questions as we can within our allotted time. So with that, I'll turn it over to Ted Whitehead.
Thanks, Aaron. Thanks to everybody for attending. I want to say something up front. I'm at home and I'm expecting a plumber and someone from the city to come. And my side door is left open that they can just come in, but my dog will go off like a 5-alarm fire. So if there's disruption, that's what's going on. Anyways, with that, let's move on with the presentation. Next slide. This is the disclaimer page. You can read this at your leisure at another time. Next slide. These are some of the funds that we offer and the returns over the past decade in some cases. Next slide. Okay, so what we're going to talk about today is what happened in 2022, give an overview, some macro trends that I see or think have been developing over the past few years, and talk about 2023. Next slide. So this is a quote by Ray Dalio, and I think it really summarizes what we are trying to do. Is everything is possible, but what we're trying to do is focus on the probabilities. So for example, the first quarter of this year, we believe is a quad 4, but the probability of that is 62%. It's not 100% guaranteed that that's the way it will play out, but the probabilities are high that that is what we will see. So anyways, the next slide. So using the quad map, it focuses on the economic cycle. So essentially, when you come out of a recession or slowdown, you get quad 1, which is PE expansion, and inflation is non-existent. Quad 2, growth is accelerating, and with that, inflation. And this is when the Fed begins to raise rates. In quad 3, you get PE contraction as inflation continues to rage on, but growth slows down. And finally, in quad 4, you get both going down. And the importance of this slide today is we are in a quad 4 where both growth and inflation are coming down, but the Fed is raising rates, not easing rates. And usually that sets up a crisis. You know, again, it's a probabilities. We don't know that one actually occurs. It's just that something may happen in the next quarter or two. Next slide. So I'm not going to dwell on this slide or the next one too long, just to show, but in each quad, there are certain asset classes that do better than the others. And within the equity market, different sectors do better and some underperform. Next slide. So on slide 10, it is more broken down into different subsectors. Next slide. So these are some of the trading signals we use, from the VIX to credit spreads to the implied volatility and just plain volume going up and down. Next slide. So 2022, yeah, definitely the bear KO'd the bull. And 2023 might shape up a little rough too, but I think there will be way more opportunities than what we experienced in 2022. Next slide. So this goes back, I believe, over 100 years to 1871, and shows you that it was the worst year for the 60-40 split. Not to say that we shouldn't have done better, we could have done better, but it was a rough year for both bonds and equities, and hasn't been seen like that, well, anything similar to that since 1969, but even that, it was a lot better. Anyways, next slide. And on bond returns, it's been the worst in over 100 years as well, and it was back-to-back years. So we're a little more optimistic that bonds are going to do better this year. Next slide. So what drove the equities down last year? It was mostly a PE contraction, which you would say, you know, going back to the quads, that would be a quad 3, and the dominating factor of a quad 3 is inflation. So with inflation and interest rates going up, the discount rate went up. And so even though earnings did not come off that much, PE multiples did, and the market retreated, or there was a drawdown. Next slide. As you can see by the different assets, it was pretty terrible across the board. WTI was the best, following the US dollar. And in equity land, energy stocks were the best performing. I think they were up around 30%. But generally speaking, it was difficult to make money, and there was a lot of volatility. Next slide. So macro trends. I thought I'd do something different with this presentation and talk about some things that have been developing, or at least that I think are important. So let's go to the next slide. So I thought we'd talk about international trade, the labor markets, interest rates, housing, value versus growth, and the trading trends. So if we go to the next slide on international trade, this is a comparison between the US and China, like who does more trade with what countries. And in the beginning, you can see back in the 80s, the US did more trade with pretty much every country in the world relative to China. But as we got into the 2000s, and even up into 2018, it's getting more dominated by China. And I think this has big implications, maybe not tomorrow or next month or next year, but there are rumors that China wants to implement some sort of international trading currency, and that would be backed by commodities. And so that may be a positive for gold on the go forward. And also, I think it just puts in jeopardy, you know, if that comes into place, what about the US dollar? What's its role going to be in the next 5 or 10 years? In the short term, I'd say it's pretty much going to be unaffected, but it is something to keep in mind in the big picture. Next slide. So with this China rising over the last 30 or 40 years, in the past few years, the US has been looking to onshore manufacturing, whereas through the 90s and the 2000s, they were pushing it offshore. Now they're trying to bring it back. It is a small part of the US economy. It's 11% of employment and 14% of growth, but it is poised to do better or grow. And this is another factor that may have implications for the labor market on the go forward. Next slide. Speaking of the labor market, you can see that through the 70s, 80s, and 90s, and I guess the early 2000s, that the labor market was growing. The number of people available to work has been growing pretty steadily, and that was with the onset of the baby boomers, etc. And now that in the last 5 years or so, it's been fairly stagnant and you know, not growing. So what are the implications of that? It's hard to grow your GDP if you don't have workers putting in the hours. And one of the other things that has happened over the last couple of years with the COVID is there's approximately 6 million US men and 3 million US women not participating in the workforce anymore, that are within that working age, that are collecting disability, and that disability is with regards to addictions or being on medications or just plain not wanting to work. Next slide. So here's another slide that's been in our deck in the past, and I thought looking at it, you can see, you know, the baby boomers are coming out of the market, the employment, and millennials going in. And right around this time frame, 2020 to 2025, there's kind of not enough millennials coming in to replace the boomers. And I also thought the other factor with boomers leaving the workforce and millennials coming in is the experience. And with that experience, someone who's got 40 years experience is a little more efficient with their time, or just has a little bit bigger knowledge base. Now, the plus side for the millennials is they're way more tech savvy. So I just thought it was a slide of interest. Next slide. On interest rates, what I'm trying to depict here is really we've had this 40 years of interest rates going down, and in 2020 they bottomed and have been steadily going up, and have broken that down slope. So I think the next trend in interest rates, longer trend, is up. You know, in the short term, which is kind of our belief, interest rates can check back to 3%, and depending on how bad the economy gets, maybe 2.5%. But the days of easy money or zero interest rates, I think, are long gone, and we're going to have to get used to higher interest rate environment. I think another factor that plays into that is boomers are retired, and they're demanding income, and so they're depleting their capital base as they get older, and so that is making money a little more scarce and driving up interest rates. Next slide. So this is a depiction of the back in 2019 and 2020, where we had negative yielding debt globally of over 18 trillion. And today, I think it's like 230,000 or something like that. Probably zero, let's just call it zero. Another sign that interest rates are on the way up and there's no free lunch anymore. Next slide. So housing, I thought this was an interesting slide on a comparison between Canada and Japan. No countries are really apples to apples, but you can see back in the early 90s, the private debt in Japan was around 213%, and in Canada we're up to 235%. And Japan experienced real estate collapse, or at least a drawdown that has been long lasting. And with the private debt to GDP up where it is in Canada, I think we could expect a pullback in the housing market, and maybe not, a steep decline, but just sort of, if there's any recovery, it'd be a slow recovery over time. Next slide. These are some comments put out by Macquarie. I thought the point number 3 is what stands out to me, and it's going to be repeated in this presentation, is softness in housing activity historically leads both to price declines and recessions. And it's that word recession that I think is on everybody's mind, and we think it's going to happen. Next slide. Oh, next slide. So this is the affordability index in Canada. It's way up at 60. I would say normal is around 45. In the US, it's around 50. And what that number means is that 60% is going towards your mortgage and your water and your heating, the cost to operate your house. So it is quite expensive in Canada to operate a house, and one of those reasons is mortgage, the cost of interest rates going up, and just the plain price of houses. Next slide. So there's a slide from Piper Sandler on the US market, and there's usually a lag with the 30-year fixed mortgage rate, and basically their belief is that the housing is not going to recover for about another 6 months, or at least not bottom. And again, like I said from the other slide, their affordability index is at 50%. It's quite high as well. Next slide. These are a couple slides from Hedgeye pointing out that home buyer traffic is all-time low, and pending home sales all-time low. So nobody's rushing out to buy homes, even though 30-year fixed mortgage rates have come off by 1% in the last 6 weeks or so, but they're still up 100% from last year at this time. So next slide. Value versus growth. Again, we like using charts. It's easier to show things. Since about 2020, value has been outperforming growth, and I think this will be a new trend going forward, especially if interest rates are an issue of going up or staying at higher levels. Value stocks tend to perform better in that type of environment versus high PE growth names. Next slide. And you can see in the back half of last year that it was the value sectors that really outperformed. And value sectors they describe as energy, industrials, financials, materials. Healthcare and consumer staples were up as well in the back half of the year, but not like energy and industrials. Next slide. And I thought these numbers were kind of shocking that in the second half of last year, the big five, the gamma names were all down fairly significantly. And I think it goes to show more of that rotation that's going on from growth to value. Next slide. So we wanted to spend a little time on trading trends and what's sort of cropped up into the market in the last year or 18 months. One may see in our weekly, sometimes we talk about CTAs, and what these are: commodity trading advisors. And essentially they're momentum following. And we get reports from Nomura and Goldman that gives us an idea of at what level these CTAs become buyers. And they're significant buyers in the market of around, when they're buyers, they're 2 to 3 billion in the amount, but it can be up as much as 14 billion. So currently the way it stands is that they are fairly long, although yesterday with the market sell-off, the medium term is now registering a sell, and that level is 39.69. On the next slide, we have the bonds, and bonds, the CTAs are short, and so we think this year they're going to come into the market and cover their shorts, and this could provide a lot of buying power to drive yields lower. And so with most bond markets registering negative 100, that means they're maximum short. Next slide. So the other thing that's driving the volatility is the percent of index options that expire within 24 hours. Essentially, this is like betting on the market going up or down the next day. And it's like going to a casino and betting on either red or black. And there's a lot of players doing this. And the short-term option expiry requires the broker or the dealer to hedge the option that they sell to the client. And because it's so short-dated, the amount they have to hedge is a fair bit. Whereas if it's a longer-dated option, the delta, or what they have to hedge, is a lot less. Next slide. So it is, all these trading trends are showing up in the market. The volatility last year is similar to 2008, 09, 2002, and I think it's going to continue. When you have players like this in the market, they are trying to pick up nickels and dimes, and so the market can trade a lot within a range within one day. Next slide. So just to summarize some of these things, on the international trade, I think that could be a positive for gold and commodities in the longer term. Gold maybe sooner. The labor scarcity, I think that's an inflationary concern. And even, I think it was yesterday or the day before, China's population declined for the first time in 2022 since the 1960s. And now India's population is the biggest in the world. Scarcity of capital, I think, has ended easy money, so interest rates are probably not going back to zero. Housing will adjust to the new rate regime, which I think, it's going to correct, and then it's not going to do a V-shaped bottom, even if rates came down. I think it'll be a longer, protracted recovery. Higher interest rate environment, I think, will favor value equities, and the new trading trends, I think, mean volatility will be here for a while. So let's move on to 2023. Next slide. I think the highlights here are the disinflation, recession call, global slowdown, and the 10-2 inversion on the yield curve, and earnings coming down, and financial conditions will tighten up. Next slide. So this is our slide from EGIF just on the GDP forecast. And the good news here is by the end of the second quarter, GDP is going to start to inflect up. And so we will be going into a quad 1 environment, which is a positive. So even though we're going to sound bearish at the moment, the shining light is not that far away. We just think there's one more drawdown to be seen, and it should happen in the next 3 or 4 months. Next slide. On inflation, it's continuing to come down, so that shouldn't be a surprise. And so 2022 was all about inflation, and 2023 is going to be all about growth. Now, the question is, where does inflation bottom out? And we think it's going to be a little bit sticky because wages are a lagging indicator, and wages are likely to remain sticky, even if unemployment starts to go up. Next slide. So you can see we're experiencing 3 quad 4s in a row, and then we're going to go into a quad 1, and I think everyone will be happy to see that, and that the markets will start to rebound at that time. Next slide. So we're still in the belief that it's a quad 4 or deflation with declining growth, and so you want to be partially invested, overweight bonds and underweight equities. Next slide. If you look globally, most economies are in a quad 4 for both the first and second quarter, and then most are coming out into a quad 1 in the third quarter. So things look better on the horizon. Next slide. We had this one in the past, just highlighting the inversions in the forward curve. It's the 10-year yields minus the 2-year. And currently, or as of yesterday, they're minus 71, which is very similar to the rates back in 1980. And so historically, this is a forecast of a recession. Next slide. So this is a different cycle put out by Piper, but it's very similar to the EGIF. And the bottom line is they believe we're in the phase 5, which is where both earnings or PEs come down and earnings come down. So you get the double whammy. And in this phase, so PEs go down, earnings go down, and credit spreads widen out. Next slide. So the consensus is by strategists is, well, our belief is that earnings, they're too high, whereas analysts are starting to take down their numbers. The strategists have earnings growing by 4.6%, and I think cumulative by the analysts, it's negative 10%, or the numbers I see, our earnings are likely to decline by 10% or more. And so earnings have not been priced into the market. If you're wondering if the recession has been priced into the market, it hasn't yet because the earnings forecasts are not at the right levels. Next slide. And again, this is from Piper Sanders, saying the same thing as really EGIF, which is tightening into a downturn. Or in EGIF, it's quad 4, you're raising rates when really you should be lowering rates, but because of the inflation, the Fed was forced to do the opposite. And so here, when you have leading economic indicators at -5, again, under the economy, look at that word, always entered recession when this happened. So again, we're starting to see more things that say always or usually that a recession happens. So it's on the come that it is going to happen. Next slide. Again, another chart put out by Piper, and they think the 4 things required for a hard landing. So if you're hopeful of a soft landing, which in Piper Sanders' belief is that you can have real estate prices come off, but unemployment doesn't come off or isn't badly affected. Whereas a hard landing is when you get both real estate and employment going down. So the signs of possible hard landing are aggressive Fed tightening, which we saw, synchronized global tightening, which we have, food and energy inflation, and banks are aggressively tightening the lending standards. On the next slide. So just focusing on the inflation part here, it's the inflation and the fact that the Fed has to raise rates to battle inflation that causes the recession to occur. As the old saying goes, bull markets don't die of old age; they get murdered by the Fed, and that's what is happening. I know we've had a bit of a recovery rally from whether you look from October onwards or June onwards, but we think there's another storm happening in the second quarter of this year. Next slide. The banks are tightening lending standards. So the difference between like 1994, which was a soft landing, and today is the banks were easing lending standards in the early 90s, whereas here they're tightening, and that it likely leads to a recession. Next slide. So one of the places where we think you can make money in 2023 is the bond market. And this is a chart put out by Sid Makhtari, technician at CIBC, showing that the trend is favoring bonds, long bonds at the moment versus the S&P. And really that's the way we are positioned in our fund. Other products can do okay as well, like dividend products or low vol value, and some of the GARP strategies he thinks might do better in this environment. We've chosen to go with a fair bit of bonds, and again, that's because of the recession call. And the recession, maybe we're wrong on that and it doesn't happen, but I think it's, again, going back to the Ray Dalio statement, you're trying to play the probabilities. And when everyone is telling you it happens 100% or nearly always happens, I think you got to play those odds. Next slide. This is a slide on unemployment, and basically what it says is when unemployment in the US is around 3.5%, if it goes from 3.5 to 6%, equities are going to underperform. Equities really outperform when unemployment goes from 6% to 3.5%, and we just haven't had that rise in the unemployment rate yet. And again, speaking to one of Piper Sandler's charts, that's not in this slide deck, they talk about housing, orders, profits, and employment. And that's really what happens is first housing goes, that happened in 2020. Then the manufacturing orders decline, that happened in 2021. And then profits are our next slide. When profits slide, companies start cutting employment. And that's what you've been seeing lately. This is a slide on the Baltic Dry Index, and it shows commodities, in that the amount of commodities being floated around is at levels not seen before. And part of this is that China is sitting on a stockpile. And so they're not in need of, in demand of the commodities right away. But anyways, again, it's a sign of a recession possibility. Next slide. Just before I talk about this slide, the plumber has arrived, so expect some noise. These are the factors that tend to outperform in the equity market when you're looking for stocks to select. Strong balance sheet, low volatility, momentum, high ROE. And these tend to outperform in a tightening market, a market where interest rates are going up. Next slide. And I think this is one of the last slides, but I wanted to show the difference between Canada and the US. Since February 2020, 86% of the jobs created in Canada are public service jobs. So when you've heard that early back in 2020 that Canada's employment recovery was way ahead of the US, they were government jobs. Whereas the private sector front, we're keeping pace. It hasn't been rip roaring. Anyways, on the next slide, in wrapping it up, I think there are a lot of major trends that have changed and changing that are going to affect the next 5 to 10 years. We don't really talk in those type of terms. We tend to look at the market in terms of 1 to 2 quarters. But I think it's important to keep an eye on those things. The Fed is not done tightening. I think there's another 2 to 3 more hikes. Maybe they're all going to be 25 beeps, but I think 50 to 75 beeps is probably in the cards. 2023 volatility is likely to continue, and inflation is going to continue to decelerate in 2023, but it may hit a hiccup or stall at some point, especially if the Fed decides to lower rates, to lower rates. So our call is really that there is going to be a recession likely, but compared to last year, there are things that will go up. So on that note, I think these are the areas of the market that we like. We like bonds, gold, value stocks, and the US dollar. Next slide. This is just a comparison of where we were in fourth quarter of 2018 and the first quarter of 2020, when we saw the quad 4 as well. And today, no quad 4 is ever the same, but our positioning is somewhat similar. Our bonds are around 49%, and our commodities are around 7.5%, equities around 25%, and our cash levels are lower, running around 12%. Next slide. And you can see that we are fairly active in the market, changing between bonds, cash, and equities. And next slide. So on that, we can take any questions, comments, ideas.
Hi, Ted. Thanks for that. I think it's a kind of an interesting coincidence that I had the same reaction that your dog did when you showed slide 55 about all of the jobs created in the government space. I started barking too. I thought that was pretty interesting. We do have a couple questions that we can get to. The first one is asking, are you saying that the US dollar will rise against the Canadian dollar?
Yes, we think so. Yeah, we believe that we're 46% US dollar.
Okay. The next one here is just asking for a comment on gold. It says, you seem bullish on gold in the environment that we're in. In your opinion, what would be the best way to get exposure to that asset class?
So we have both. We have the GLD, and that's about 7.5%. And then we have around 5% in gold equities. You'll get more bang for your buck in the gold equities. I'd say we've had a nice little run recently. We may get a check back into the high 1880s thereabouts. But I think this is your best hedge for if the Fed pivots sometime this year, or when and if they do. And I also think that as I talked about that international trading currency, if there's any truth to that, then I think you could see gold really take off.
Okay, thanks for that. Here's the next one. You're saying that we are and will continue to be in a quad 4 for the next 1 to 2 quarters. Is there any data that can change that would make you reevaluate this?
Well, it's just really the comparison of this year relative to last year. And as the numbers come out, they gradually change the input. I would say we're fairly certain that it will be both first quarter and second quarter, but things can change. And also you have to, if the market happened to drop, say 10 or 15% next week or in short order, that may negate, even though the data would still come out as quad 4, the market's already priced that in. So it also depends on market reaction to certain data.
Okay, thanks for that. This one is along the same lines. We're told the economy feels the pain of rate hikes about 6 to 8 months later. If that is true, and if the Fed is still expected to raise this spring, then does that equal quad 4 for longer?
Not necessarily, because on a comparison to last year, things will be a little bit better. So I would say that, again, we have to see how the data comes out day by day, and it's dynamic. So these things are forecasted today, and they are subject to change. And I think as you see in quad 2, going from quad 1 or quarter 1 to quarter 2, there's a marginal difference. It's not that great. So that could flip. You could flip to a quad 1 sooner.
Okay, I've got another one here. It says, many are hoping for a Fed pivot at some time this year. Let's say that this does happen. What moves would you make in the portfolio?
We'd have to reduce our bonds and go into equities, because I think the pivot would be inflationary. And it depends on how far off. Like, if it happens, I think, in the first half, then it will end up being inflationary. If they hold off till December, that's likely to be a better time. But since, again, we try to just talk out 6 months. So if they pivot in the first 6 months, I think you got to prepare for more of a quad 3, where owning stocks would be better than owning bonds.
Okay, next one. As far as markets not bottoming yet, do you expect the final bottom in 2023 or 2024?
Well, again, I can't see really that far out. I do see a bottom happening in the first half of this year, and then the market recover. So I think it'll just be a volatile year, where in the end we probably close out the year somewhere around 3,900, even though maybe we go down to 33 or 3,200 in the meantime.
Okay, next one here. What do you think of the current opportunity in Europe, Asia, and emerging markets compared to Canada and the US?
I think the foreign markets are showing signs of life, and basically they are cheaper than the US market. And so there may be more opportunity there. Again, if it turns into it all comes down to a value market versus growth. And if it's a value market, there tends to be more value stocks in those areas because they're commodities and industrials. That doesn't mean the US market is bad. It just means you need to go out and buy a Caterpillar or Conoco or Baker Hughes or something like that. But as you know, in the index, getting back to that gamma slide, those stocks still represent 18% of the S&P 500. So if they're continue to be under pressure, the index could go down, but more stocks can be going up. And that's really kind of what I see playing out, is that there will be stocks to own.
Okay, I've got one final question in the queue here. Do you see a chance for reacceleration in inflation at some point this year? And do you have any protection in the portfolio should this happen?
I would say that's something of concern, because, like I said, the Fed pivots too soon. And we have the China reopening that may put pressure on energy prices. So our hedges would be our gold position and our energy stocks. And we've been rebalancing the portfolio to, like last year, we were more in staples and utilities, and those sectors we've taken down.
Excellent, thank you. I think that's it for the questions in the queue. So it looks like we're going to be getting a little bit of time back, finishing before the top of the hour. But before we wrap up today, I would like to remind everyone on the call that our next webinar is scheduled for February the 15th, where we will be featuring an update on the Arrow East Coast Income Advantage Alternative Fund, which will include a discussion on current interest rate environment, credit spreads, yields, durations, and how this fund may help reduce volatility for your fixed income sleeve. Then on February 16th, we'll be featuring Arrow Capital's CEO and Senior Portfolio Manager, Jim McGovern, along with Chung Kim, Portfolio Manager, sharing their outlooks and updates on the Arrow Global Advantage Alternative Fund and the Arrow Canadian Advantage Alternative Fund. So I look forward to joining all of you on those calls. And for those of you from Manitoba and Saskatchewan who joined today, I look forward to seeing you in person soon. And please reach out to your Arrow Capital Management representative if there's any more information that you needed from today's call or anything else that we might be able to help you with. So with that, I wish you all a great day. Thank you very much once again for joining us. Thank you, Ted, for making yourself available. And I wish you all a good day.
Thanks a lot.